Now we have some viewer mail.
We have viewer mail?
Yes, we do.
I like that. So if you have viewer mail, please send it to Doug@riskandrewardtv.org. I would be happy to answer your question.
And this is from Dave in Belmont, and he writes, I saw the Groupon stock went from $20 a share to $29 on the first day. How can someone get in on an IPO? Or since I didn't, should I buy it now that it's a bit lower?
Okay. Thank you very much for your question, David. So there's several questions here. The first thing that we should talk about is that this show says nothing about whether you should buy or sell stock. So there's nothing I'm about to say that tells you whether you should buy Groupon or not. So let's make sure that we're clear about that. Second part is an IPO is an initial public offering. So it was a private company, and then it offered shares or ownership to the general public. And it goes through a process through the investment banks, and the investment banks underwrite the issue. And what they do is they go out and find a group of investors, and they do what's called a roadshow, and they find a bunch of people that will buy it if it goes public. And they say, okay, it's going to go public. We don't know exactly what the price is, but can we count on you to buy some? And they find enough people that will buy it in the public market so they can have an initial public offering. After the initial public offering, that's where private shares get put in public hands. The public shares then trade on the secondary market between the people who already own them. Okay? So that's how an IPO works. The key is to get an IPO is you need to know the investment bank so they get the shares from the private hands at the $20 price before you get to the $29 price, which means you've got to be such a good customer of theirs, they want to give you that easy $9 gain, which is what you're looking for. You want that sweet, quick, easy money. Well, since they know it's easy, quick, sweet, easy money, they don't hand it out to just anybody. So if you were doing a lot of business with a firm that was underwriting IPO and giving them lots of trading commissions while you were doing it, of course they might think that you should get some IPO shares.
Special bonus.
A little special
there.
bonus. Thank you for all those millions of dollars in commissions. Here's $50,000 worth of IPO stock. And so it's very difficult to get into the hot IPOs because they know they're going to be priced below what the market price will be. Hopefully not by that much, but and so on. So Groupon soared the first day.
Yeah, they jumped 50% to a high of $29.52 just at their opening on the NASDAQ.
That's right. So there's boom. You can see that in the chart. They went boom. And then they came along and have dwindled down since then. And more recently, they've allowed to be shorted.
Oh, here's the Financial Times reported that when Groupon first became possible to short, the shares this week, short sellers borrowed nearly all the available shares, according to Data Explorers, which tracks the stock lending.
So the minute they can short it, everybody grabbed it and start shorted it. So I'm not saying whether they should have or not. I'm just saying that that's part of being in an IPO, an initial offering, is that these things happen. So unless you're an advanced investor, you should use caution here because IPOs can be volatile. They don't have a track record. There's a lack of analysts following them that are really analyzing the companies because they're new. There's lots of sales hype trying to get the IPO out there. And always sales hype is something we take with a grain of salt. And of course, it's a way for the insiders to cash out. So if you had a bad company and you want to get your money out of it, what would you do? You go IPO so I can get my money out. Now, I'm not saying that's what they did here or that anybody else did.
Apparently, that's what the short sellers were thinking.
Well, of course. They think if you're selling it short, it's because you think the stock will go down. So I urge caution on any of the IPOs, lots of hype, lots of media attention, but unless you're on the inside track, and the only way to get there really is to spend a lot of money with an investment bank or know somebody, you got to be on the inside, then I urge caution with them because they sound like they could be really easy, quick, fast money, but they're only easy, really quick, fast money if you're on the inside. And if you're not on the inside, you're on the outside, and that's
warning.
Yeah, so I urge caution.
And what's your takeaway?
My takeaway is looking for big, fast gains is a natural way and that everyone looks for easy money. But be sure to do your homework and find out what's actually going on. And when you dig a little deeper, you'll find out that easy money isn't all that easy.